Market paying close attention to protests, both peaceful and violent, break out across America. Our next guest says the unrest isn't the #1 risk to this rally right now. Let's bring in Mike Wilson, the chief U.S. equity strategist at Morgan Stanley. He joins us on the phone tonight. Mike, great to speak with you.
Thanks, Melissa.
So what is the risk then?
Well, I mean, look, we don't want to downplay the violence over the weekend. It's a terrible event. But for the economy and the recovery itself, I think the biggest event in the near term is going to be can we get the additional stimulus passed through Congress that, we already have the House bill, and what form does that take, and do we get the unemployment benefits extended as everybody's expecting? There is a risk that it doesn't get done, and I think that's a potential risk. Obviously, there's a risk that we have a spike in cases as the economy reopens. So those two, I think, would be top of the list for me, something that we're watching closely over the next couple of weeks.
As we watch the protests, Tom Lee over at Fundstrat points out that the protests can be found in 75 cities across the United States. And he writes, we now have transmission risk in high gear in the U.S. in 75 cities. I mean, people don't protest with social distancing. So in as much as the protests represent not only a risk to consumer sentiment and confidence, but also just a transmission risk, a higher risk of a second wave. How are you viewing these protests, especially the longer they go?
Yeah, I think that's a really important insight. I mean, it's actually also going to provide a very good test for whether or not there's going to be a second wave, right? Because if we don't get a spike after these protests, that would be a pretty good sign that perhaps the virus itself has been eliminated, or at least more eliminated than what people are fearing, and that would be a good thing. So it can go either way, which once again, it's why we're going to be watching it very closely. We're reopening quickly. A lot of the country is doing that. I think it's the right move. The violence and the riots this weekend obviously is not being done with social distancing, as you point out. So those two things together, if that doesn't result in a spike in cases, the market will probably take that pretty constructively. So we'll see how it goes.
If there's use of armed forces, Mike, is there a martial law risk to the markets?
Well, I don't think we're getting a little ahead of ourselves at this point. I mean, whether or not it's going to lead to shutting down cities again for safety reasons. I mean, we're seeing that at night with the curfews. Let's hope it doesn't. Let's hope it doesn't get to that. We'll deal with it if that happens. Right now, it's so hard to predict. Let's just hope it doesn't go there.
Karen, you got a question?
I do. Mike, excellent call both last year and this year. But in your constructiveness, your bullishness, is there more that you expect from the Fed, or is sort of the stimulus the last leg for a while?
Yeah, look, it's a combination of a couple of things. I mean, first of all, we all know that this is a very steep recession that we've had. We're in it now. And typically, you're going to get some kind of recovery off of that. I think and we've written about this extensively, I think because of the health crisis nature of this recession, we've gotten more stimulus than we would have gotten in a garden variety recession or even a steep recession where there wasn't a health crisis. And so that's going to help affect essentially a V-shaped recovery of some form. It doesn't tell us about the sustainability of it, but we're getting more confident that between the steepness of the decline with the probably faster reopening that people were thinking about 4 to 6 weeks ago, fiscal and monetary policy working in concert and still growing in size, by the way, that's a pretty good cocktail for a powerful second half recovery, and that's what the market's looking forward to. And now we just need to see if it can sustain.
And just quickly, Mike, if we do have that second half rally, is it the reopening trade that wins the day?
Well, I think we're getting the reopening trade now, right? So look, the market, I could argue, is pricing in some of that recovery. I mean, I think a lot of folks would argue the market's way ahead of itself, but markets are always ahead of themselves. They're discounting machines. I think in order to get even higher prices, we're going to need other positive surprises. And I think rather than the reopening being the surprise, is that we're reopening without a deadly second wave, or I think more importantly, that they don't lock down the economy, even if we get second wave. And we're better prepared for it now with the healthcare system. So I think as we reopen and we start to live with this virus, and we understand that we can actually function okay as an economy, that's going to get business confidence, consumer confidence up, and then with the stimulus working in concert, you can create some pretty good velocity in certain areas of the market.
Mike, thanks for joining us.
Thank you, Melissa.
Good to talk to you. Mike Wilson, Morgan Stanley. Guy Adami, you agree?
Well, to a certain extent, I agree. I mean, I think the market is very expensive as well, but I think to Mike's point, I don't know if valuations even matters, given vis-a-vis all the stimulus, all the money that's been pumped into the system. You know, Jim Cramer said something this morning, I'm going to paraphrase, but the market doesn't have any emotions, and that's exactly right. There are people, 41 million people out of work. Obviously, we're seeing what's going on outside of that, and yet people will turn on the news tonight, and at some point they'll see the stock market is within a whisper of an all-time high. And, talk about a V-shaped recovery. I don't think you're getting the economy, but you're clearly getting it in the stock market. And the chasm between the two continues to grow.